Hi guys, so today's video will be about the basics of the Forex market. So I will talk about what is Forex market, what are the participants of the Forex market, and where we can find ourselves in this whole system. And so we will briefly discuss the history and how does it work. So this is video basically for the beginners who are not familiar with this concept. I will try to, in the most simplest manner, to describe what we are dealing with on the Forex market. So let us start with the simple question, which is, what is Forex, right? So the answer to this question is that this is a decentralized market where we are exchanging one currency for another. So the name itself comes from two words, which is first one foreign and exchange. So as you can see, if we erase reign and change from those two words, combining that, we have the word Forex. So as I said, it is the decentralized exchange market. So unlike the stock exchanges, foreign exchange market is decentralized, as I said, and it means that it doesn't have one building or one company that gathers all of the transactions, which means it's a little bit more complicated than the centralized one. But before we will dive into the further explanation, let's talk about briefly the history, because it will explain to us more or less why and how the system, this foreign exchange market, looks as it is today. So it started as soon as the World War II ended. The countries that won the war decided to use the US dollar as a global reserve currency, simply because the United States after the war had the biggest and the most developed navy. Therefore, they could provide security for the global trade. And in exchange, the countries obligated to use a US dollar as a exchange currency, as a, we can say, global currency, to settle all of the global trade transactions. What it meant, basically, is that when Germany for example, a company from Germany wanted to buy something from, let's say, Japan, they needed to exchange their Deutsche Mark, German mark, into US dollar, and then exchange for the Japanese yen. Why? Simply because, first, they agreed to that, and second, because, for example, for the Japanese, German mark wouldn't have any value, but the dollar back then was backed by gold. So any country on the planet would want to have US dollars, because you could always take the US dollar and exchange it for the particular amount of gold. So it would mean that the dollar always had the value for everyone. So that was the basis of the foreign exchange market back then. But when in 1971, so when the US government took the dollar off the gold standard, the whole system was, we can say, rebalanced, remanaged again. And after that, there was no problem to exchange, for example, this German mark for the Japanese yen, because those countries were participating in the global trade agreements, so on and so forth. So that is the history, very, very briefly. And we can go further with the explaining of the current market participants. And so let's type that. Point number 2, market market participants. And those are, firstly, we can say commercial banks. So those would be the banks, the names you most likely know, like Goldman Sachs, Deutsche Bank, JP Morgan, HSBC, I don't know, Barclays, so on and so forth. Second participant of the market are central banks. So central banks, for example, like Federal Reserve, European Central Bank, so on and so forth, Bank of Canada, etc. And the third participant, we can more likely say that are international corporations, but those who have their own dealing desk. So each participant has its unique role on the market. And for example, banks serve as an intermediary between the clients and the market. So when a company goes to the bank and say, for example, okay, let's say it is a car manufacturing company from Germany, again, like, I don't know, Volkswagen, BMW, or Daimler, Mercedes, and wants to buy, I don't know, some parts for their cars, let's say semiconductors. It's a very recent topic. Semiconductors from a Taiwanese company. So what they need to do is to, of course, exchange their euros to Taiwanese new dollar. And what they do, they send the request for the bank to purchase X amount of Taiwanese dollars in order to buy those products. And the bank goes to the market and does this deal for in the name of their clients. And basically, this is how commercial banks work on the market in very basic explanation. Central banks have a little bit different role. They also participate in transactions. They also create the supply of a particular currency in their own way. But most often they influence the prices by the changing in their monetary policy. So, for example, by raising and lowering interest rates. And the third participants, the corporations, which have their own dealing desk, they do the same as the banks do. They need to exchange their money in order to make a transaction, make a purchase on from the foreign country. So recently, the most often corporations doesn't have their own dealing desk, because it is just not cost effective, and they most often rely on banks to do this job for them. So now let's draw some scheme in order to better visualize how this system works. So firstly, we have central banks, and the function that they also exchange currencies between each other, creating the currency reserves. And next we have commercial banks. So let's say we have bank 1, bank number 2, bank number 3, bank number 4, bank number 5, and bank number 6. And that they are exchanging currencies between central banks and between each other as well. So you can see, okay, how it works more or less. And probably you are now wondering where we are, traders like me and you, in this whole system. So let's talk about an example. Let's say you have $10,000 and you want to go to the bank, open an account, trading account, and exchange the currency in order to obtain a profit. So if you go to the bank, a bank would say to you, if they will agree, they would tell you that, okay, we will let you trade with this amount of money, but you will have to pay for us this amount of commission. And for your information, this commission would be huge comparable to your capital. So it would be very hard to obtain any profit if you would have to pay such commission for one transaction. And the reason for that is simply because the banks are dealing with huge amounts of money. They are making transactions of on hundreds of millions daily. So a client that comes to them with $10,000 is more of a cost than an opportunity to make a profit. So yeah, that is how it is, how this system works. And right here, the Forex Broker comes in place. So basically, Forex Broker is a company that gathers investors like you and me with a small and mid capital and make an agreement with the banks in order for them to fill the transactions of Forex Broker clients. And I am quickly explaining you how it works. So we have the system over here, and we have the Forex Broker. They have agreement with, for example, I don't know, 1, 2, 3, and 4 banks, which provides the quotation to the Forex Broker, and they obligate to the Forex Broker that they will fill every transaction of their clients. But because Forex Broker gathers hundreds and thousands and sometimes millions of, depending on the size of company, of clients like you and me, the Forex Broker is one entity and is a big client for the bank because they operate in millions, in huge amounts of money from their customers, right? So what you are gaining as a client of a Forex Broker? Let's say you are client number 1. You have your 10,000 on your account, and you are sending a request that you want to, for example, go long on a Euro USD currency pair. Doesn't matter the volume. You are sending this request to the broker. And what the broker do? They check which bank right now offers the best price for the euro against US dollar. Everything is happening automatically in milliseconds. So of course, by the system, it is chosen the best price at the moment. And let's say I don't know, let's say a bank number 3 gives the best quotation, the best offer, and fills the transactions of yours. That is more or less how it looks, how it works from the backside, from the kitchen, we can say. And your benefits as a client of a broker are firstly and mostly the low transaction costs. This low cost of transaction. So simply that would mean you are making more profit from the same transaction. And not only that, you probably noticed that I said that the Forex Broker gets the best pricing at the moment. So this means that you are getting the best price which is available on the market. If you would be trading with one particular bank, you would have only pricing from this one bank. But because you are trading with the broker chooses the best price at the moment. So as you can see, this model is very cost effective. At the end, what I want to add is to talk about the difference between the currencies and stocks. So let's discuss that. We have stocks, and the thing that you need to know is that stocks are a rising asset. So if you would like to draw a chart, it would look like that, right? The price would differ from time to time, but the overall trend is to the upside, because stocks are referring to the company's, we can say, economic condition, And as we know, most often the companies are just developing, are growing, are making profit. That is their purpose in the economy. So the currencies, on the other hand, and as for the currencies, we should treat them more as a commodity, as a means of payment. It's not a rising asset. Therefore, there is no such concept as a good or bad price of the currency. So there is no correlation between the cheap currency and the weak state of the economy. And when the currency is expensive, that also doesn't mean that the economy is doing good. You can check it on the various charts, compare it to the various indexes. You will find no correlation over there. So there is also no equilibrium point, no equilibrium price point where it is perfect for particular economy, for the particular country. So this is why you shouldn't look at the currencies from that perspective, from that point of view. The currency prices are, constantly changing. They're fluctuating day by day, and the central banks of a particular economy, particular countries, are constantly trying to influence the prices. Therefore, it is pointless to analyze currencies and currency pairs from that point of view. And this is why, when analyzing the currency pairs, the best way to do it is to use technical analysis tools. So with that being said, I will end this video. Thank you for watching. Hope you enjoyed it. And yeah, learned something. So remember to follow this channel for more, and check LiteFinance on other social media, on Instagram and TikTok, because I am also posting over there too. So yeah, thanks again for watching. Till next time, guys. Bye.